Hey everyone, welcome to another edition of the Buddy Study Group. And today we are resuming our study hall series, and we are going to be talking about annuity long-term care this time around. So if you all do not know or haven't been here for a study hall session, we really just take the time to, from a high level, analyze one piece of the long-term care market at a time and taking it from multiple angles. So, of course, talking about the major carriers and products in that marketplace, but also just speaking about it at a high level from a conceptual standpoint, from a sales standpoint, what makes this product type stand out, what may be overlooked, or what are the key sales ideas of each of these markets and best practices for navigating. So I'm going to go through some of these high level concepts, but I would also love to hear from you all if you have some good experience working with annuity long-term care. I would love to hear any case studies or what products you're into lately, or just anything you have heard or know about this marketplace so that we can all learn together. Does anybody have anything that they want to contribute before I dive right into it? Or any findings to report early on? Mark, anything you want to say before we chat and kick it off here?
Just what comes to my mind, and I wouldn't consider myself an expert in direct sales of annuity long-term care, but I do think you have to think a little differently than when you're offering like a traditional long-term care policy. Um, I think you're going to talk about, Pension Protection Act and the asset repositioning, but I do think, a lot of clients may have that objection, even if they don't say it, that why am I getting my long-term care on an annuity policy? Just like when we see that on the life hybrid policy. So keep that in mind, I would say, when you're offering this is even if you have a sales process that you use for long-term care, you may want to adjust that for the annuity long-term care sale if you know that that's going to be a fit for your client.
Yeah, and you, I think, did well in alluding to one of my main talking points, which is asset repositioning, especially taking advantage of the PPA to create a really nice sales opportunity for clients where it's the right fit. But I also think from the annuity side, one of the big advantages is underwriting. So I think for clients who generally have health challenges but are financially qualified to look at annuity long-term care, and especially just taking it one layer deeper, those who have an existing annuity that's not earmarked for anything, I think the kind of key term, though it's lazy itself, is lazy annuity money. An annuity that's maybe already sort of accomplished its goal, or the goal that it was designed to reach, isn't important, isn't necessary anymore. Using that to reposition to long-term care are probably the big two pieces that I would cover on this session. So obviously, we're looking at something that is generally more geared to the senior market. So when it comes to, say, age ranges, I believe we have a maximum age range of about 40 to 85. But you're going to be talking to many people about annuity long-term care, probably in that maybe 55 to 80 range, most of all. Again, not just because of the age range for products, but because these folks are in a financial time in their life where it would be likely most suitable. These are folks that are nearly or already retired in many cases, that have done a good job saving, and generally have high assets, but in retirement may have sort of less income, right? So that's generally what I see as kind of our ideal client for annuity long-term care. And really, the goal for many of these folks is they have an existing asset that can be repositioned into annuity long-term care. So for those of you who don't know, because I know we get some new folks on each and every session and watching the recording, the Pension Protection Act is really the star of the show here for many annuity long-term care cases. So, what that is essentially going to do for us at a high level, the PPA says that if we were to 1035 an annuity with significant gain, but really any amount of gain into an annuity long-term care product that is specifically 7702B long-term care qualified. If we were to take long-term care benefit out of that long-term care annuity, essentially what would have been gain in the annuity we transferred over will be received tax-free as long-term care benefit. So for many folks who really have that concern top of mind of how can I get myself to a better tax situation? How can I continue to mitigate tax risk? This is a really huge play to be able to make in many cases for folks. So I think that's the most existing no-brainer opportunity, and we're seeing really a lot of carriers using that in their sales materials. Obviously, it's a pretty easily printable sales idea, but even just promotion around their annuity products because of that. We saw that One America, I believe it was last year, did a huge campaign on their annuity care product, and that was very successful from the numbers and got a lot of people really in that sort of sales frame of mind. But this is good for really any of the carriers out there to be able to look at this. And just kind of moving away from that for a second and into the underwriting side of things, I think the great sales idea of the PPA combined with really light underwriting processes relative to other product types for annuity long-term care, those two things kind of go hand in hand, right? If it's an easy process from being able to find the money for some clients and to um, get them into this plan and the ease of underwriting, ease of process, I would say there, either simplified or in the case of Equitrust Bridge, guaranteed issue underwriting. I think those two things go hand in hand to create a really easy process for folks who we have to remember, historically have been harder to get long-term care solutions for. These are folks who are generally 60 plus, and any health issue from, say, a traditional or hybrid underwriting standpoint is going to be treated with a lot more scrutiny than somebody who is 10, 20 plus years their junior, right? So um, we talk about this a lot when it comes to long-term care, more on the group side, but it also applies to individual. It's sometimes almost as much about process as it is about product. If it's kind of easy to access the product from an underwriting standpoint and from just a premium payment standpoint, either affordability or ease of using existing assets, then we have the recipe for a pretty popular product on the market. So I would
Hey,
say,
Jason.
yeah, yeah, go ahead, Mark.
No, I don't want to repeat what you said. I think you said it very well, the types of sales. One other, though, that I would mention, because actually this was the reason my mother-in-law bought an annuity long-term care, so I've had
Hmm.
personal experience offering the product, is that she actually got the best value. And there were two reasons for that. She bought it when she was approximately 75. So when you look at the life long-term care, traditional long-term care markets, you don't get as much leverage,
They tend
right?
to
In
go
that
underwater, right?
70, 80-year-old range. Well, that annuity, because it can give you that two times or three times immediately, much better value as you get closer, to those older ages, and it's unisex priced. So again, because of those two factors combined, I could say, that putting in a lump sum was a better value than even the recurring premium options for those other products. So I think that's another
100%.
reason that you'll see these be more popular is just the pure value itself.
Yeah, and that brings up something that I've kind of implied but haven't explicitly talked about, which is not all clients will financially qualify for this type of product, right? So that is really our limiting factor here when we talk about annuity long-term care. Spend some time talking about how open it is for many, but you have to have the capacity to make a single premium or 1035 exchange in order to qualify for this product from a financial standpoint. Okay, so that's where some folks won't really have access to this product. But again, I think we're dealing with an age group that tends to be a bit more asset heavy and income light. So you're going to find a lot of candidates for this product regardless, for the annuity long-term care market. We're not dealing with flex pays. We're not dealing generally with pay-as-you-go premiums. I think you may see some flexibility once you have done an initial dump in, with one or two carriers. But at the end of the day, that's going to be the lever they pull to kind of control who can access the product or not. I'm getting all this money up front if I'm going to offer all the other benefits that I'm offering with these products. So I would say, yep, 1035, easy peasy, agreed. When it comes from, or when it comes to the agent side of things, and what do I need to be able to do to write annuity long-term care? Generally, these products do come with extra annuity suitability training. So that is one thing to keep in mind. If you are working with a case that is close with any carrier, make sure you check in and see, is there individualized annuity suitability training that I have to take at the carrier level and at the state level. So if you're working in a new state, that is something to pay attention to. Yes, shout out to Reg Ed. Um, Agreed.
By the way, that is really easy as well, so don't let that stop you. It's
Yep.
usually just check the box on these slides and you're approved. So
Just a process thing, right? Like just make sure that your case doesn't become slow as molasses because you didn't try to get these things done proactively and ahead of time. Because we all know that there is enough paperwork to go around beyond all that. Uh, I think the major players here, I mentioned one, um, One America's Annuity Care, For Care, Annuity Long-Term Care. So that is from Global Atlantic Forethought. They've got like 17,000 different names, but those are a few. Nationwide's Care Matters Annuity is brand new to the market. So they've been an interesting player, and I'm really interested to hear from any of you out there. Have you started working with Care Matters Annuity yet? I think it was a natural play for Nationwide, for a number of reasons that we'll get into in a little bit. And then Equitrust Bridge is um, really the product that I think has the most carved out niches, um, given the fact that it is a fixed index annuity, given the fact that it has guaranteed issue underwriting and underwriting for essentially a better rate, better leverage. So it's not just guaranteed issue. Everybody gets the same rate. Everybody's in and included. But if you are in better health, you can qualify for better leverage. I think that's a really interesting way to offer a product. And all of those products that I mentioned are Pension Protection Act eligible. I would say if we're looking for similarities, Bridge is the one that kind of stands alone in its design. I would say For Care and Care Matters Annuity are the most similar to each other as far as product underwriting structure of sorts. Um, and with Care Matters Annuity, you're seeing a lot of the things that you know and love with the Care Matters hybrid solutions. So I think that's an interesting one. Now, I hear some things going on in the chat. I hear
yep.
with my eyes, people
Yeah,
talking
so
about Equitrust.
I'll report back a little bit. Chris, and if
Yeah,
you want to get off mute and share your experience, because I know you had a good experience with Equitrust, that would be great. Before you do that, though, Jason, one thing I want to make special mention of is there's a lot of annuities in the market that have ADL doublers.
yes.
So I know we're talking today about annuity with true long-term care riders, which makes them Pension Protection Act capable. Annuities with ADL doublers, just keep in mind that they can be good products as well, but the benefits are not received tax-free. So it's
Correct.
just a different setup there. And you do have to make sure that the ADL doubler does cover home care. Most of them cover facility, only a few of them also cover home care. So if you are offering those products, we love all those products that can solve the long-term care issues. Just read the contract because if it's not 7702B, all the contracts can be different. So we're going to focus today, obviously, on the ones that are 7702B.
Unbelievably important points there. And just remember the session we had with Ramona Neal that was talking about life hybrid solutions. So there are some with 7702B long-term care riders. There's lots of benefits that are exclusive to those types of setups. And if they have separately identifiable long-term care premiums, yada, yada. But we did talk about chronic illness riders as well and the differences between them. And essentially, look, a client can be put in a better situation on both sides of that equation, ADL doublers or 7702B long-term care, but you need to understand what each of them are and what each of them are not. So I totally agree. Read the contracts, stick by a carrier wholesaler or a trusted contact. I know that sometimes there are wholesalers out there who are unaware of 7702B long-term care annuities, and we have to tell them, look, if your product was structured this way, you'd get XYZ benefits and sales ideas to be able to add to your portfolio. So don't just trust word of mouth. Please read the contracts because it really, really does matter specifically for these types of products. Just wanted to mirror what you were saying.
Yeah, Chris, I know you're typing the chat. If you're not in a good place with your microphone, you can ignore this. But yeah, if you want to share your experience, I think a couple of people also were interested in your preparation for the Equitrust interview that you
Sure
had mentioned.
thing. Let me turn the camera back on. So, yeah, the Equitrust Bridge, great product, 1035 exchange, looking for lazy money. The kind of the question of, if care is needed, where are you going to pull the money from? Old Don Quante, thing you had shared was what bucket do you use? Well, they might say, well, maybe out of my CD or savings, or I've got this old annuity. So those old annuities are perfect for a 1035 to Equitrust. I had a lady in her 70s, stage 4 cancer, and she got 300% leverage on her dollars. Um, so I sat down with her and her husband, explained how the process goes, that they're going to do a video interview, they're going to stand up, sit down, you know, walk a line, repeat, things. And, the guy, the husband, he's got ADD a little bit. I told him, hey, go, don't have anything around you, stay super laser focused. I just knew him, so I told him to stay focused, so they get the best leverage. I go, there's no do-overs. Well, there is. You have to wait. But so they're able to get, the maximum benefit out of their, especially anywhere else, she wouldn't have gotten that much leverage at their age. The ADL doublers that you talked about, be really careful of those because I hear agents talking about, oh yeah, this annuity, it's got ADL doubler, 206 ADLs, then you'll get double of the payment. Well, if you look at the illustration, most illustrations run out of money in the cash value, the account value, about the time care is needed. So somewhere in the early 80s, right? Well, there's no cash value left, so there's no doubler. In Equitrust, they do offer a doubler to continue, but there has to be cash value when it starts for it to continue with that doubler. Now, with married filing jointly, Equitrust only pays 1.5%, 1.5 times instead of a double, for married filing joint.
You're
That's
talking about on their non-LTC product, right? So they
right
have
on
two
their
annuities.
annuities or marketplace, you know, long term, short term. Yeah, they've got a few different ones, but they've got some very competitive annuities out there for income
Mhm.
annuities out
Right.
in the marketplace.
Yep.
I just did one through Midland, which is a sister company to North American, And they usually run pretty side by side as far as contracts. But there's a huge difference, and you brought this up, Mark, is North American, you have to be in a nursing home to get the doubler. So 2 of 6 in a nursing home. Midland, you just have to have 2 of 6. So those funds could come in, you could use it for home care, things like that. They both pay, the payouts are, I mean, within a couple $100 of each other, very close. And in the 60s in Texas, it came down to Equitrust, um, and then North American and Midland. Well, Equitrust, like I said, on the Married Family Jointly is a point and a half instead of 2 on the doubler. So Midland was the winner with that home care versus the nursing home care. So very important to, like you're saying, yes, those dollars can be taxable unless it's a Roth. But yeah, it's a lot of things to think about, when you utilize
Mhm.
those other products like that. But to sit
Yeah,
down,
one way to simplify it, and I've just learned this from our, BJ and IMO friends that focus on annuities, is if you know what the annuity is primarily designed to do, that can be really helpful. Is it designed
Yes.
for income? Is it designed for growth? Is it designed for long-term care? Right? That's going to be your primary reason why the client should buy it, and that's probably going to have the more favorable contract language and illustrations. If you think the annuity can do all those things very well, you're probably mistaken,
Yep.
right? That's why we have a robust and competitive market. It's you have to know what the client's goal is, and that's going to lead you to the right solution.
most people are sold the wrong annuity in the first place, because like you're saying, Mark,
Yes.
there's really 3 buckets, you uh, income, accumulation, or long-term care. And, you know, so if it doesn't fit in those 3, but some of my age, I'm 66, so I shouldn't really be talking about accumulation. It should be more about income because I'm probably gonna either I can't work anymore maybe down the road and I need the income, or I don't want to work down the road here. I want the income. So, where do you want to put the dollars? And the sooner you get into income annuity, I mean, not your age, Jason, but someone my age, or maybe a few years back, that's a great time for income. But the rest of the time is accumulation. For someone like you, Jason, it's gonna be accumulation. So
Right.
you shouldn't have all these. I ran into somebody who had an income annuity about your age, Jason. I started going, this is such a waste of money. You're paying a point a quarter for the income rider, and you'll never use it. It's crazy.
You've probably run into one of maybe uh 100, 200 people my age in the world that have an annuity even to speak of that's not, bequeathed from a family member or something of that nature in some sort of trust setup. But you brought up so many good points, and I love when you guys just share any sort of perspective because it brings up a couple of talking points um, that I overlooked kind of in my initial assessment. Number one, yeah, you have to represent the product for what it is and for what the goal is. And I think if you're looking at, say, annuity products on a spreadsheet, it can be really misleading to know what you're actually getting out of the product if the spreadsheet is not worth its salt in actually talking about some of those living benefits, some of those um, chronic illness or ADL doubler or long-term care benefits, right? And it's important that the client knows the difference between them because it's not like all the contract language is going to be in a spreadsheet. So they may come within a couple of $100 of each other in a single premium, but there's more than meets the eye. So that's something to look out for, but you have to represent the product for what it is, right? And clients will ask, you know, couldn't I just go out on the market and get an annuity that's going to perform much better from an accumulation standpoint, from an income standpoint, whatever it may be? And you kind of have to remind them and be that rudder that, look, the primary objective of this is long-term care benefit. And we're looking at this specifically in an annuity solution for these reasons. Maybe it's a tax play and we're leveraging the PPA. Maybe it's an underwriting challenge and this is going to provide us good access to 7702B long-term care coverage, which is not so easy to find at certain age ranges. So just remember to be that rudder and remember to represent the products that we're talking about here today as a long-term care solution. And as a matter of fact, we're repositioning an annuity that's, if you're doing a proper financial analysis, is not accomplishing much for you now. Like Chris said, he's met with tons of people with mismatched annuities. I know many people have similar experiences as well, where people do an annuity review and they say, this does not make sense for your situation. If you're dealing with folks who have that long-term care need, that's kind of your perfect opportunity of found money, repositioning, and getting the client to a place of more financial efficiency, risk management, protection, all that good stuff. And I want to share a chart from Equitrust because Chris, you had mentioned your case study of our 70-year-old who was dealing with cancer diagnosis and ended up with 300%. So this is essentially based on whatever class you are looking at of coverage. Secure is essentially our guaranteed issue level. But based on your age, there are different long-term care coverage ratios that you can end up with. Obviously, you can see that this is designed to provide at least a little incentive to start looking at folks who are at the younger part of the age range, right? Your ceilings are just in general much higher than, say, somebody who is in their 70s. But yeah, for a 30-year-old woman, stage 4 cancer, you said, Chris, 300% is almost clipping the ceiling of preferred. So that's a really interesting case study to hear. But this chart is very, very helpful. And I got to give a shout out to Equitrust and Nationwide as well. Both have really, really good agent portals to help you learn their products. But Bridge, I have to give an extra shout out to because there is no agent login required to access their agent portal and their product information page about Bridge. So you get all sorts of materials here. What is Bridge? Never Stop Wellness Program is another interesting benefit to this. Underwriting is super, super important with Equitrust. Of course, you can choose to take the GI and forego the underwriting process, but if you do go through that underwriting, like Chris said, you're going to want to do a lot of prep for that interview. And this is not just something that I've heard from Chris. I've heard this from many specific to Equitrust. Just make sure they're right and ready. State approvals, there's all sorts of stuff available on Equitrust's agent portal page. So I highly recommend checking it out. It's agents.equitrust.com/bridge. And then Nationwide has a page of its own, but it's going to require a financial professional login. And I just want to, I think many people will talk about annuity long-term care. They'll use the word hybrid. And in a terminology-laden industry, I don't want you to get this confused with life long-term care hybrid plans because though annuity products offer some live, die, or quit protection of sorts, it is not in the same way that your life hybrid products will, but there is sort of a value proposition there. Your mileage definitely varies by carrier, but there are generally some, death benefit options. There are definitely, surrender values that you can come away with, but there are surrender charges for these annuity products generally in the first 10 years. And then, of course, the living benefit is always great, but I think these products warrant really deep dive sort of comparisons. I don't think they're very easy to spreadsheet as far as I'm concerned, unless somebody's had some really good success spreadsheeting them through some sort of software or in their own practice. I also agree with Chris that if you're using Equitrust and looking at a fixed index annuity product at all, no shiny objects. I would totally agree with that. I would stick with what's standard, what works, what's recommended. and focus on the long-term care benefit first and foremost.
And I think a big reason for that is like we talked about earlier, if you're not focused on accumulation or growth, the client is not planning for the right reason, the product, you get them off track, pretty quickly. Um, and I think that if you keep it simple, that's going to help you also move it forward and make the sale. The more complex you add to it, the more delays, the more concerns, and a lot of times that's what the killer is. It's just there's too much. They bring it to their advisor, and all of a sudden it's like, what? I don't believe in index products, and now it's really totally derailed what you were trying to accomplish for a long-term care perspective in the first place.
Yep. Um, and I want to talk a little bit about Nationwide's Care Matters annuity real quick because I think this is bringing to light something that you'll start to see more and more, especially if you work with Nationwide on the hybrid side, if you work with One America on the hybrid side, on their asset care side, you will almost be forced, if you have any declines at all, to become familiar with annuity long-term care because Nationwide now has this sort of similar practice as One America, where if somebody is declined for asset care or for Care Matters too, generally underwriting new business will follow up with an offer for their annuity product. So you were declined for asset care, here's an offer for annuity care. Here's what we could offer. Same thing with Nationwide. Decline for Care Matters. Here is an offer for Care Matters annuity. Obviously, it's a great strategy from the carrier standpoint, right? Because this allows us to offer the client something with more favorable underwriting, still get them some long-term care coverage. And of course, as the carrier, even though we can't offer them the product they were looking for primarily, we're making every effort not to lose the sale. So I think you'll see that as you start to work with more of those products. But let me just share a little bit of what I have here on Care Matters Annuity. Let me just pull it up for you quick. Okay. So what I'm looking at from a perspective of their sweet spots is cash indemnity benefit is always nice. That flexibility, right? Being able to pay for informal care, fully guaranteed long-term care charges. The simplified underwriting is quite simplified as far as I'm concerned. And from what I've heard from the good folks at Nationwide on the product side and the underwriting side is that they're targeting about 95% approval. So you're going to have a client who's in pretty dire straits not to qualify for Care Matters annuity. And if they don't, Equitrust is sitting there as another option that is guaranteed issue. So I really like how those two products can kind of compare and play off of each other. Again, we talked about the Care Matters 2 declines. For just riders, so say we're having an inflation rider added to Care Matters annuity, there is separately identifiable premium for the riders only, not for the actual long-term care benefit itself, unfortunately. But we do have an interesting play there. Legally married spouses can continue the Care Matters annuity contract of their spouse as an option, but without long-term care. So I thought that was interesting. Maybe not the whole reason for the sale, of course, but I thought that was an interesting little add-in. The issue ages are interesting, and they're going to depend really on there are certain age ranges that can qualify for certain underwriting tiers, as we understand it. So preferred and standard underwriting are for age ranges 40 to 74, and 75 to 80 is eligibility for select underwriting. And we'll get into that a little bit in a second. Still a number of states that have yet to be approved for this product. I feel that a few will likely come within the year. Some may never come, right? We know that story well enough. Minimum premium of 36,000, max of 400,000, 3% interest crediting rate guaranteed for the life of the contract. Here's the surrender schedule. Again, single premium only, pretty standard story for the annuity market. And here's where I say that they're kind of similar to 4Care's annuity long-term care product. And they are open with us in saying that they were kind of inspired by this structure. But your underwriting is going to essentially be comprised of knockout questions and questions that determine whether or not you'll get a 2 times or 3 times multiplier for long-term care. Okay, so um, if you are standard underwriting, you will have the 3 times multiplier, but 4 years of coverage. With preferred underwriting, you can access 6 years of coverage with a 2 times multiplier. With select underwriting, you have 6 years and a 2 times multiplier. But you can see the 6 years is broken out a little differently depending on if you're preferred or select underwriting. So it's 2 + 4 years for preferred and 3 + 3 for select underwriting. And something that I haven't seen yet from carriers, 100% international benefit. So again, Nationwide is a carrier that has been committed to kind of offering some of these below the surface benefits that are becoming more and more popular and more relevant in our day and age. International benefits definitely one of them, and really cool to see that on this product. Let's see. So Mark, you're just replacing me with the AI summary here.
You
We can
noticed.
have, we can have ChatGPT speak to him. Inflation
Yeah.
protection,
And
pretty
the reason
interesting.
I put that out there, by the way, is I just wanted to mention that AI has gotten quite good and much more accurate, less hallucinations when it comes to products. So don't be shy about just typing in questions into your favorite AI tool, whatever that might be.
They're stealing from people like us. That's why.
That's
We keep
true.
feeding them the information. Um, Again, this is why the conversation with clients is so important about the purpose of the annuity. Annuitization is available, but if you elect it, long-term care benefits are forfeited. So just remember that. And the remaining contract value can be paid out via lump sum or annuitization on death. So spouses are allowed to continue the contract without long-term care, but you must be legally married. So no domestic partnership rules there. 90-day with that nationwide typical retroactive elimination period is very, very attractive as well. So on the 91st day, Nationwide's going to pay you back the first 3 months and your first month. So that is very, very cool. Um, and the underwriting for preferred, standard, or select. Preferred is going to be your 3 times multiplier. And remember, you got different structures, but 2 times multipliers regardless with standard and select. But they are going to give you 6 health questions. How's that for simplified issue underwriting? So if you answer yes to 2 of those questions and only 2 and no more, you have a preferred rating on your hands. 4 yes answers is standard, 5 yes answers or more is a decline. So not too bad. We're going to ask you 6 questions, and to qualify for this plan, all you have to do is be able to answer no to 4 of them. So that's a really interesting process. And you can quote this on WinFlex and in Nationwide's agent portal as well, nationwidefinancial.com. And I think this is a very interesting competitor. I think we're going to start to see more hybrid carriers offering something like this. The annuity market is hot. Lots more people own annuities nowadays, and I just think this is important to understand from a conceptual standpoint. Remember, we are not in an employment market like we were 40, 50, 60 years ago where people retire with a pension, which is essentially a guaranteed income stream, right? So people are actually creating their own pensions through private purchases of annuities. So there are annuities out there. It's become a very, very hot market. Even retirement accounts have annuitization options of sorts attached to them nowadays. Um, so I think it's important to not leave that out of your fact finding, especially when you're meeting with somebody who meets some of this other criteria. This is an opportunity to open up an easy on the mind, easy on the wallet sale for long-term care for a client.
Yeah. I'll give you some more data too, Jason, just to reiterate what you just said. At the LTCi conference in March, I heard two interesting facts. One is that there are at least one or two other carriers that will be launching annuity long-term care soon. So, like you mentioned, this is getting to be a hot market. And I also heard from a credible source that Nationwide had a goal for the year of what annuity sales they wanted to hit, and they had already hit it in March.
Not
They're
bad.
they're way past on pace for what they're looking to do. So again, all of that is good news. It means that we're going to see more competition, more innovation, and growth there. But it's a signal, right, that that's a market you need to pay attention to.
It's demand, right?
Hmm.
The end of the day, you don't you don't reach sales goals for the year in March without some sort of demand. It's a good signal that you offer a good product and have good distribution, right? So all healthy signs there. And of course, you know, it's always normal in the back of your mind to say targeting 95% acceptance. That can't be realistic, right? But just remember how the underwriting breaks down, very predictable amount of leverage that they're offering with these, so they can generally tend to um, take more risk and really try to offer this to a wider group of folks. And I think when we think about the consumer first, that's what the long-term care market needs, more options for people to be able to engage with, right? I think the worst thing we run into as agents, as specialists, as people who are professionals in this industry is telling a client, I don't have anything for you. And I've been beating this drum since I was at Buddy INS and even before that the market is continuing to move in this direction where we're not having to have that conversation as much as we have in the past. There is no true one size fits all product. But generally, if you've got a good financially qualified client who understands the importance of long-term care coverage and you're willing to turn over every stone, um, you're going to be hard pressed to find a client that is 100% sealed out of something that is going to contribute to their funding of professional care, right? And that's a big thing.
Hey, Jason, I know that you may not be covering it in detail, but I do want to give a special shout out to One America for a couple of reasons. One is, as you mentioned last year, they had a huge fire sale because they really simplified the underwriting criteria down to five knockout questions.
Hmm.
Not necessarily with the extension rider, but just for those pure 1035 sales. And obviously that was a really smart strategy because, we saw kind of a blockbuster sales there. They also have indexed annuity care, so they have a different, kind of a
Correct.
version there. And they go up to higher ages. I think they go up to 87. So
Yeah.
there are going to be sweet spots with each carrier. Obviously the newer ones, the two newer ones that Jason covered are really competitive and great value. But don't forget, One America as well, because they've been around. They're the OG, one of the
They
OG
are. They're like
products.
the first one to do it. That's why they deserve a shout out.
Yeah.
And definitely trust your specialists. I think all of the carriers that I mentioned, you cannot miss. They have excellent internal folks at One America, at Nationwide, at Equitrust. For those big three, definitely lean on someone. If you don't work with um, if you don't work with annuities just in general, I know it's a long-term care product. I know you'll feel very comfortable talking about how the long-term care benefits are delivered and some of the advantages, but for the kind of annuity mechanics, if you feel out of your depth, just lean on someone because the folks at these carriers are trained um, up to their eyeballs in training materials with just annuity solutions in general. So never be afraid to leverage an expert. And this is a great opportunity, I think, for a referral partnership with somebody who is a traditional annuity specialist. We've had our friend Tracy and Zach from the Annuity Giants Facebook group on to give us some Annuity 101, some Annuity 102. And those were very useful sessions just for helping us to understand how to deal with existing annuities we may run into and how to evaluate them. But if you have a relationship with an existing annuity specialist and you can have somebody there who identifies annuities that are not doing what they're supposed to for the client, you can help them understand which ones may be a good candidate for a repositioning into something that's going to help the client with long-term care. And it's a very reciprocal business because you may have long-term care clients that you find are good candidates for annuities or good candidates for an annuity review. So if you've got somebody you trust, I always say, long-term care specialists and financial planners, financial advisors go hand in hand. Long-term care specialists and annuity specialists, long-term care specialists and life insurance specialists go hand in hand for that reason as well. They help you find the money, they help you do analyses that you may be out of your depth on, and at the end of the day, it can be a really symbiotic relationship. So I wanted to close on that. Ron did ask about carriers on the horizon with a joint life long-term care annuity. Mark, do you have any inside intel on that?
I think the most likely is going to be One America, which I think already
Yeah,
has the joint
yeah.
annuity,
Mhm.
and Nationwide, which has the joint Care Matters, the life hybrid. Very likely, I could see them doing that, but I don't know for
I heard
sure.
mentions whether it was whispers or just kind of like it may be in the plan. I didn't hear anything 100% committal as far as like a release date or concrete plans, but I would expect it at some point here.
Yeah, and the new carriers, again, I don't have any official notice, but picture, the carriers that we know in the hybrid space, like your Lincolns, your Securians. Those are the companies that I think are most likely to come out with new annuity products.
Yeah. Why do so
LTCi.
many educated and higher net worth people shut down when an annuity is mentioned? I think it goes back to kind of what Chris had said is you really need to help the client understand that there are different types of annuities for different types of goals. So they may look at your long-term care annuity and they'll look at the accumulation value of the annuity and say, this is bogus. I could go out onto the open market and get something with 3 times the accumulation value. And that's where you have to say, yeah, you absolutely could, because the goal here is not accumulation. It's actually leverage for long-term care should you need it. And, if you've got an annuity that can be repurposed with really no hit to your financial picture, you can get it working more efficiently for you for long-term care, not worry so much about the accumulation. I think people get stuck on those numbers. What's the accumulation? What's the base policy sort of income irrespective of long-term care? They don't think about the extra leverage or tax mitigation. So you got to be a rudder for these kind of products and keep people focused on why you're offering this product to them. Accumulation equals bond portfolio. Yeah, there you go. Um, Anybody else have anything they
My
want to
husband
share?
about this.
Yeah. Well,
I'll put you on the phone with him. He just shuts down. But
yeah.
you're so
I
right.
mean, you can't win them all, and sometimes
Well,
people
after
sometimes people
49 years.
don't want to have their mind changed. They just kind of like everybody has had a prospect in their career that is really just there to argue at the end of the day. And you can try to be non-confrontational. You can try to be a trusted consultative advisor and say, look, this is why I'm offering it to you. I mean, this is all I can say. And I know there are products out there that do that better. I concede that. But at the end of the day, they're just trying to hear their own voice, and that's where you just kind of let them go, right?
Well,
Awesome. Well, I think that'll do it. We're pretty close to the top of the hour. Hope you guys have enjoyed these study hall sessions. Um, this is just a way where we can kind of take one product type and put it under a microscope and really point out each product type's specialties, ideal clients, and what are the carriers that we know, love, and trust to take a look at. I believe we are just about wrapped on study halls for the year. Let me see. We've done traditional, we've done hybrid life long-term care, we've done short-term care, we've done annuities. I mean, those are some of the majors. Maybe we'll do kind of alternative long-term care planning for a study hall at some point here because there are some non-insurance, of course, long-term care funding strategies that we could take a look at. But hope you guys have enjoyed. We'll still do product roundups and things like that to keep you up to date. We're going to have other presenters coming in down the road to talk about specific products. But yeah, hope you enjoyed and thank you for your contributions. They help make this what it is. So be well, and we'll talk to you this time next week. Bye, everyone.